Ladies and gentlemen, I woke up this morning to the notification that PayPal had fallen beneath my watchlist price target of $70 per share. Now, PayPal is ubiquitous in the world of peer-to-peer payment transfers and online paying for goods and services. Now, PayPal also owns Venmo, which is probably the most popular peer-to-peer money sending app, or at least it's the one that I use and most of the people I know use to transfer money between each other to either like pay people back if they picked up the tab for lunch, that kind of thing. Just for convenience sake, it's one of the easier ways to send money around between people. Now, in their earnings release, it seemed like it was pretty much all good news regarding growth, earnings, and everything along those lines. They're projecting huge growth in both GAAP and non-GAAP EPS. GAAP EPS, they're expecting to grow in the neighborhood of 20%, non-GAAP 24 to 26%. They're talking about buybacks to the tune of $4 billion. And, this little blurb from their CEO mentions that they're confident in their momentum and they're raising their full year 2023 EPS guidance as a result of how well they think things are going. That being said, the stock price declined by over 12% on the back of this. Now, what I'm finding is what I think is kind of a weak sauce, nothing burger reason for that. Sliding as outlook on operating margins disappointed, despite raising revenue and profit outlook. So it's like, hey, revenue's going up, profits are going up, they're beating expectations, but we're a little disappointed in the operating margins, so outlook, so we're gonna just sell off to the tune of 12.5%. Like how on earth does that make sense? It boggles the mind, right? Because the top line and the bottom line are increasing, and it seems like things are going in a positive direction. Now, the thing I am actually worried about when it comes to PayPal has nothing to do with their top line, bottom line, or their margins, at least in the near future. But FedNow is coming out soon, and I can't help but think that the Federal Reserve offering a way for banks to instantaneously transfer money at a low cost is somehow going to eat into the business of a company like PayPal. Now, the Fed has made clear that FedNow is not intended to kill or replace other money transfer options, but just because that's not the intention doesn't mean that won't be the consequence. So that's some kind of squirrely language there, and I would expect there to be some kind of an impact to the business of a company like PayPal, that where money transferring is fundamentally the business. Okay, because this is a fast, low-cost option, and I would expect that it's going to eat in to some extent. It's just to what extent. I don't personally know, but that would be something I'd be interested in knowing before getting too terribly tied up into a large position in PayPal. Now, when it comes to PayPal's, what might be a good price to pay, you pull up the DCF calculator, and when you plug in the defaults with a 10% discount rate and the previous 10 years of free cash flow growth, you get, before even accounting for the balance sheet, a fair value of $130 almost dollars. Now, I think that's definitely a bit rich, okay? I would expect, even though short term they're talking about earnings growth in the 20% range, which would seem to line up with this number, I would think, 10 years is a long time. They're going to have some years where they crush it and do maybe have 20% growth, but they might have other years where they miss, or where they even have a decline in revenue or profit or cash flow. So I think it's a good idea to go with a much more conservative number, because 10 years is a long time, and account for that kind of thing. Even if you do think they're going to put up strong growth more often than not. So I would cut it, actually like more than in half, to account for just the fact that as they get bigger, it's harder to grow, and also just the fact that you could have different years where things actually go the opposite direction and don't go particularly well. And as for like a long-term growth rate, I would actually give them credit for 5% instead of 4%, just because they are, they're an international company, so they're not totally reliant on the U.S. economy by any means, and they are one of the more convenient ways to transfer money to, if you have friends or family outside of the U.S. It's pretty much either PayPal or Western Union, as far as I can tell, are like the options for it. There's some other ones out there, but those tend to be the most convenient, and I by far prefer PayPal where it's possible. So, okay, when you factor all that in, you come out with a fair value of about $68, which that does seem pretty reasonable. But considering some of the risks, etc., involved in a company like PayPal, especially with the Fed now on the horizon, etc., you might want a higher discount rate than 10% to factor that in, to give you more of a margin of safety. So now you could throw in an 11% or even a 12% discount rate to sort of factor that in, give yourself more of a margin of safety. Now, that ends up giving us a fair value of more like $58 per share, which, I still don't think is, too terribly unreasonable. Some people might say, oh, that's way too cheap. Well, okay, let's give them credit for their balance sheet too. Okay, then we come out with a much more, I think, realistic $65-ish that you would want to pay for something like PayPal if you're conservative and value-oriented in your modeling and projections. So this is part of the reason why I threw in a price target of 70 in my watch list, because I figured, hey, if it's falling below 70, it might very well be approaching what I consider to be a pretty good buy price, or a price where maybe I want to start selling puts, right? Because I checked the options chain. If I was to sell cash secured puts on PayPal at, say, $63 per share a few weeks out, I could get almost 2% on my money just for doing that for a few weeks. And then if I do get assigned, I would get assigned at $63, already have collected 2% on my money, and what I would be expected to make about 12.5% if these projections came through, if I paid $63 for PayPal. So all in all, I would be pretty happy with that outcome either way, whether it just continues on and I don't get assigned and I just make the 2%, or I get assigned at a discount to today's price and with conservative future projections on cash flow growth, make a 12.5% annual return expected. I think that all in all, that's a pretty decent deal, and that's why I'm suddenly a little bit more interested in PayPal at current levels versus when it was flying a bit higher before. I definitely think when it was $100, back in August 2022, that was definitely too rich for my blood. I think anytime it's been in the, below 70 range is when I've really been interested in taking a look. And I think last time I looked at it was actually like last fall when it was in the high 60s. I did actually even sell some puts, I think, around the $65 range back then. I just never got assigned. So I think my thesis still pretty much holds for PayPal, although I am more concerned about FedNow currently than I was back then. Maybe it's just because we're actually closer to it coming out. But that's my thoughts generally on PayPal. Let me know what you think in the comments below. Hop onto Discord if you want to have these kind of chats with the group on an ongoing basis, and subscribe to the channel for more as we continue to move forward. Take it easy, everyone. Have a wonderful day.